my name is Daniel Dubois. I'm the co-founder and president at Key. Prior to starting Key, I started 2 venture-backed companies that I sold a few years ago, then joined Airbnb full-time, where I managed most of Canada and some of Eastern United States, as well as a new group that focused on future technologies that would impact the future of home sharing 3 to 5 years out. Fintech was actually a big part of that. As you can imagine, our mission at Airbnb was to create a world where anyone can belong anywhere. And we can't live up to our mission of creating a world of belonging when there's 2 billion people in the world that don't have access to the banking system. They don't have trustworthy, verifiable government ID. So if we were trying to actually validate them to build trust on our network, they didn't belong on our platform because they didn't have trustworthy ID. So we looked at everything from micro payments on mesh networks to solve worldwide connectivity, to actually creating an identity layer or becoming a bank for the underbanked in the world. All that to say, I came across a massive opportunity when I first went to the first principles of understanding how real estate works. And today, I know I only have 15 minutes, so I'm going to keep it really quick, but I'm going to try my best to explain to you the first principles of real estate and how real estate, biggest disruptor, bar none, is fintech, and how fintech is going to be eating the real estate world as things progress. So I'm going to dive into a little bit of the founding principles behind Key and what we're building. So to begin with, I'm sure everyone here is well aware, we have an access and affordability crisis when it comes to home ownership. So millennials it's inaccessible to own a home in 60% of the cities around the world. In Toronto, it takes 21 years on average to save up for a down payment. 21 years, it used to take 4 years. And in Vancouver, where I'm from, it's even worse and takes 29 years. And this challenge is even more difficult for new immigrants or people that are coming into the country that don't actually have credit history. So young people, they have 2 options, right? They rather rent, where they're locked out and they're stuck on a rental treadmill. Their income typically isn't going up at the same rates as housing prices, so they're getting further and further out of reach of being able to own a home. Or if you're fortunate enough, you own a home, usually from the support of the bank of mom and dad. You have to qualify for a mortgage, and then you have to maintain a certain lifestyle to service your debt. So 2 options: you're either locked out of the market renting, or you're locked in with a conventional mortgage. So what if there's a third option? That's what we're creating at Key. It's a new model of home ownership where you have most of the benefits of owning with the freedoms of renting. So let me dive into how that works. And before I do so, I'm going to tell you actually just a quick story of how this came to be. So as I mentioned, I was at Airbnb. While I was there, I saw firsthand how regulations were impacting home sharing. So cities were regulating, such as Toronto, Vancouver, San Francisco, many around the world, that went to principal residents only. And then you have buildings, condo boards, HOAs, stratas, that have regulated Airbnb, where the only way that you can rent is if it's over 30 days or sometimes over 90 days. So regulations are hitting Airbnb from both angles. You have to live in an Airbnb-friendly building, and you have to live in a city where it's actually your principal residence. You can't sign a lease and then rent it out full time. So I started thinking through, what would it look like if we create an entire ecosystem where everyone is a homeowner? And I actually, my cousin and I own a 198-unit residential development, and I started looking at how is blockchain and these new technologies democratizing access to investing. So I started to think really hard around, what would it be like if we raised large pools of passive investor capital, we use that capital to actually buy real estate, and then everyone who lived in one of our suites is actually an owner. And the more they own, the less rent they pay. So we'd allow someone to be able to own a home for only $15,000, yet every month they could choose if they wanted to buy up some more of their suite or sell 20 grand worth of shares in their suite and travel the world or fund their wedding. So it would be treated almost like a rental where it's short notice and go, but you actually are in the game. You have a piece of real estate that you can call your own. You have a security of tenancy where you can't be given 60-day notice short of where you have to evict because your landlord's son or daughter is going to U of T. So I pitched this idea, or very similar idea, when we were first getting started, to someone named Rob Richards, who's founder of Plaza Ventures. And Plaza Corp is one of the largest real estate developers in Toronto. They built $7 billion worth of condominiums. So Rob asked some really good questions and then told me he's been thinking about this for over 5 years. And part of what he's been thinking about is back to the first principles, which will help you understand why fintech is going to be eating the world of real estate. So this is the way condominiums are built right now. You have a developer who usually outsources through a third party, an exempt market dealer, who's making 2,000 phone calls to high net worth individuals to collect checks from 100,000 to 500,000. They usually spend, a pretty good amount of money, maybe upwards to 5% on the high end, on just a broker to place all the capital to then be able to go out and launch a pre-sales program. They then spend months on a pre-sales program. They create a brand around the building and marketing and broker commissions and whatnot. And once they sell enough of their units to investors or owner residents, then they take that package to the bank and they try to unlock conventional bank financing, which also has a bunch more cost, time, and hassle involved with it. So if you're the Harvard Endowment Fund, as an example, if you're a fund where your minimum check size is $100 million and you can't own more than 5% of a portfolio, there's no way for you to invest in condominium, because you have developers who are raising from high net worth individuals. They're launching pre-sales. They're building as quickly as possible once they unlock their bank financing. Then once they build their building, they unlock their pre-sales, they return the capital to the high net worth individuals, they wash their hands from it, and they move on to the next development. So every single building is siloed. So the Harvard Endowment Fund isn't going to manage hundreds of relationships with different developers on a building by building basis. They want to invest in a portfolio. So unless you consolidate $2 billion worth of an asset class, there's no way to make it commercially accessible. So these large pools of patient capital are investing in ports and timberlands and multifamily and office buildings. But condominium, which is one of the strongest alternative asset classes, even now with COVID, with taking just a small dip but still holding its value, great buying opportunity right now, by the way, is blocked out for the Norwegian sovereign wealth funds of the world to be able to participate. So when Rob was thinking through this entire journey while sharing office space with one of the largest condominium developers in the city, he saw firsthand all the time costs and hassles that these developers go through. Banker boxes up to their elbows when they go to close. You have a bunch of different pre-sales that are coming to your office because they want to change their countertop package. It's just messy. And on top of it, 10 years ago, we used to sell all our inventory to owner residents. Probably 95% of the inventory was going to owner residents. Fast forward to today, 95% of the condos that are sold in Toronto are now going to investors. And about half of that is local investors, and the other half are foreign investors. So we're not actually building for end consumer. We're building smaller. We're building just for investors. We're not actually building for people to be able to own a home that they can thrive in and be part of a community. So Rob is a longtime tech guy. He invented SaaS. He's one of the first SaaS-based companies in the mid-90s. Took it public on the NASDAQ in '98. And for his entire career, he's been inventing these new models, of these forward-thinking models of commoditizing consumer costs by putting things in the cloud, such as, look at AWS as an example. The cost of innovation has gone up 10x. The cost of actually being able to get into market has gone down 10x. So things are moving so much quicker. You don't have to go out and buy server farms to be able to launch a new product. You can just simply have servers through AWS and consume proportionately. So we started to think through, what's the fintech layer if we were able to actually create an investment vehicle to allow people to invest with $100 million checks on the same, the large patient capital to buy entire real estate, to supplant the need for a conventional mortgage, and allow people to consume real estate proportionately the same way that you can consume serving web servers incrementally. So we call it home ownership as a service. So SaaS has changed software forever. HaaS will do the same for real estate. It's easy to consume incrementally. It's easy to have mobility, low cost, and no friction involved. So with Key, it's not a steep curve like you have with conventional real estate. It's actually a much more a linear curve. It's actually a complete linear curve where the more you own, the less rent you pay on a monthly basis. So the way that it works is you have a Key suite that's owned 100% by passive investors. Soon, small individual investors will be able to invest on the same terms as the GICs, teachers of the world that are actually buying real estate through our platform. We then replace a tenant agreement, the Residential Tenancy Act. We have something called a co-ownership lease. So we have people living in suites that are actually co-owners with the passive investors. So they still pay a monthly rent, but once again, their rent is determined by how much equity they own in their suite, and they share on the appreciation of the asset with the passive investors. So everything is in an app, and every month you can choose if you want to buy up or sell down some of your equity position. So just to make it really clear on what we've actually built, from a user experience perspective, you might think, how much of this is a fintech company? Well, a few weeks ago, I know I opened my presentation with saying it takes 21 years on average to save up for a down payment in Toronto. A few weeks ago, we had a young single mom who's a gig worker, so she works as a shopper for Instacart, and she was pulled over on the side of the road, and she bought a home, a condo, in 15 minutes with under $15,000. So pulled over on the side of the road on her iPhone. So let that sink in for a minute. From it taking 21 years to just save up to get into the market, and then weeks and months of legal work, brokers, closing documents, 6 to 8% in transaction fees. Now you have a gig worker pulled over on the side of the road, and in 15 minutes, she goes into our app and starts an application process, which does KYC, AML, verifying identity, credit check, being able to verify proof of funds, being able to do a high value transaction where she can actually contribute $15,000, having automated valuation methodology. So every month you can know exactly what your suite is worth, and then being able to incrementally buy up or sell down your equity position. So this is a first time ever in real estate that you can consume incrementally and you can own a home without owning a mortgage. And Key is resonating. We have over 100 people every week being added to our wait list, and we're in stealth. This is one of my first times even speaking at an event. We've been reached out by media multiple times to do feature articles on us, and we feel like we're just not ready yet because we already have way more demand than we have supply, and we're focused on ramping up our supply before we start talking about Key more publicly. But I can tell you right now, we have grade 5 school teachers in our system. We have Tibetan refugees. We have first year engineering, software engineers at Shopify. We have a whole host of people with different walks of life, from empty nesters whose kids have retired, where they want to own a home, but they don't want to be house poor. So now they can retire gracefully in place, and they can choose how much they want to own, or if they want to take out money as needed for their life. So it's been a ton of fun. It's a massive, massive mission of being able to create a world where people can use real estate as a source of freedom and prosperity for everyone. So I have no doubt that in the future you will buy your house from or sell your house to a company, not an individual, that the residential mortgage is great and a high leverage product that is potentially here to stay, but no longer will real estate be binary where you're rather just an owner or a traditional renter. Fintech is coming in and going to empower people to own a home years sooner with a fraction of the cost. And we're really grateful to be part of it and to be the first company that has empowered people to own a home without actually having to own a mortgage. Anyways, my name is Daniel Dubois. My email is daniel@lifehatkey.com, and I look forward to keeping in touch. Feel free to reach out anytime. Cheers.